Rohr here with an early, concise highlight on Friday, December 5th, 2014. It's currently 6:15 a.m. U.S. Central Time. Once again, coming to you a bit earlier than usual because we want this posted prior to the U.S. employment report at 7:30 U.S. Central Time. So what does all this mean to the markets? Well, we're up $2 this morning as we look at the short-term charts, hourly on the left, 30-minute on the right for the U.S. S&P 500 future. And of course, that puts the market up into just shy of that major 2075 area. We're still leaving as the key Fibonacci marker in here, even though the market traded temporarily in the wake of that ECB announcement. We've often said that the foreign government's quantitative easing, now that U.S. data is stronger, sometimes is better for the U.S. than it is for the domestic equity markets, and we'll take a further look at that shortly. But for right now, 2075 is the relative topping line on the weekly chart. It moves up to about 2079 next week. We could round it off and say 2080 and say if this market can escape yesterday's 2077 high by more than a few dollars, it's probably saying that it wants to be accelerated right into the top of next week on that channel. The recent churn above and below the breakouts doesn't mean a whole lot because, of course, the market has churned above and below them, so it's back to the big levels. And in that regard, the market did hold early in the week around the key gap at 2052, going back to 2 weeks ago, Thursday into Friday, on the Bank of China rate cut. And this week, later on yesterday, or pardon me, early yesterday, later on in the week, the market held into the key 263 to 262 gap with very little slippage. So generally speaking, it looks good. The burden of proof would be on the bears to at least knock it below yesterday's 261.5 low in order to prove any real near-term weakness, and we shall see. But we will note that even though it came back yesterday, the weakness out of late Wednesday into early yesterday did diffuse the hourly MACD from getting out above its upper runaway gap, and it's nowhere near it now. So that's an important factor, and we'll see how it reacts to the employment numbers, most importantly. That pretty much does it for the short-term view of the S&P 500.